be a part of this webinar tonight. Before we get started, I just want to give you a quick introduction about me and the National Cattlemen's Beef Association. Again, my name is Colin Woodall. I'm the Chief Executive Officer of the National Cattlemen's Beef Association. This is my 19th year with this association, 3 years as the CEO, and before that I worked in our Washington, D.C. office, where I was the head of that office for 10 years and kind of worked my way up into that position. Before I worked for NCBA, I worked for a U.S. Senator from Texas, where I did agriculture, water, energy, and natural resource issues. And before I moved to Washington, D.C., I worked for Cargill in their grain division, where I managed country grain elevators in western Kansas. I'm originally from Texas, and my family has a small cow-calf operation. I also want to talk a little bit about NCBA, because while I know many of you on the call, on the webinar here tonight, are familiar with us, some of you may not be. NCBA has been around since 1898. We are the oldest and largest national trade organization representing U.S. cattle producers, and we are truly a grassroots organization. Our leadership, our president, our vice president, our regional vice presidents, all the decision makers are cattle producers just like you. And that's what gives NCBA its heft, its weight, and its influence in Washington, D.C. Because when we go and we talk about issues, we're not talking about my opinion as staff. We're talking about the opinion and the position of the members of this association who have debated the issues, who have voted on the issues, and have ultimately given us, as your staff, the playbook, our policy book, to go and engage on Capitol Hill. And we have a lot of things to engage on right now. It is a long list in Washington, D.C., and I want to highlight some of those for you here tonight. First of all, you need to understand that we have a full-time presence in Washington, D.C. Matter of fact, we are the only cattle organization, solely cattle organization, that has a full-time presence in Washington, D.C., where our team does nothing more than work on the issues and the priorities set by our membership. We have 18 of those individuals in Washington that are working with the White House, the administration throughout the executive departments, Congress, other organizations, international diplomats, and more to make sure that we are always the voice of the cattle industry. And this week was a great example of that. Yesterday was the first Monday of October, so it kicked off the session of the Supreme Court. And one of the first cases to be heard was the Sackett versus EPA case. The Sacketts are a couple in Idaho who wanted to build a home where the EPA said there were some wetlands. And while it doesn't have a direct connection to cattle because they weren't putting cattle on that wetlands, it is another step in the bigger issue of waters of the United States, or WOTUS, something I know all of you have heard about because we've spent about 15, 16 years throughout agriculture fighting back against this. Most recently, the 2015 Obama rule, which would have made ditches, low spots, ponds, stock tanks, a jurisdictional water that could be controlled and regulated by the EPA and the U.S. Army Corps of Engineers. President Trump was able to change that, fix that, turn it around, but now with President Biden in place, he wants to revisit that. And this case in particular could have a big influence on what that rule ultimately looks like. So NCBA is a friend of the court in this particular case, and we were there as part of that hearing yesterday to make sure that this is a priority for the court, priority for the administration, and they know just how many people outside of the Sacketts are really taking a look at this. We believe in clean water. All of us do, because without clean water, we don't have cattle operations. The question is not about clean water. The question is about the jurisdiction of the EPA and the U.S. Army Corps of Engineers, where it starts and where it stops, in making sure that they don't come on your farms, they don't come on your operations and tell you how to use a ditch. So more to come on that as we continue to see this case play out and also influence the administration's rulemaking. That is one of many things on the environmental side. Many of you have also probably heard about the Securities and Exchange Commission's effort to regulate greenhouse gases. The Securities and Exchange Commission should be focused on publicly traded companies and the transactions in that arena. They need to be focused on Wall Street, not on Main Street, because they don't have any expertise in the world of greenhouse gases in the environment, It's not their jurisdiction. And unfortunately, this is just another attempt to try to, once again, overregulate agriculture. So we are pushing back, working with our friends on Congress, and we have friends on both sides of the aisle that are letting the administration know, and Chairman Gensler at the Securities and Exchange Commission, the SEC, that they need to step back from this. Something you may have read about that took place last week was the White House Conference on Hunger, Nutrition, and Health. This is the first time one of these has been held in over 50 years. And when you look back at the first one in 1969, it gave us things such as food stamps and also the dietary guidelines for Americans. The dietary guidelines for Americans come up for reauthorization every 5 years. And every 5 years, it's a fight to make sure that we keep beef in the center of the plate. So that's why we made sure we were at that conference last week. I was there to represent our industry because it was focused on hunger, but the groups that were involved were non-government organizations, hunger groups, charities, food banks. There wasn't a big show from agriculture. Now, it wasn't because we weren't interested. It's because that's not where the administration was focused. So those of us from agriculture that did get invited to go, we made sure that we were there, and we sent a very clear message that you can have all the goals about ending hunger in this country that you want, but without us as the food producers engaged, you're not going to be successful in it. And I do believe that that has resonated, and we've had the opportunity to reinforce that particular message. So it was good that we were there to make sure that that ag voice, but specifically the beef voice, was being heard. Let's turn real quick to some marketing issues, because I know this has been a big issue within the industry and something that's front and center of everybody's mind. And a lot of that naturally goes to some of the actions in Washington, D.C. in trying to bring the government into the marketplace more so than it already is. In particular, we're talking about Senator Grassley and Senator Fisher's bill, and then also the special investigator bill. A lot of people have asked, where's NCBA on this? As I mentioned earlier, this is something that we have spent years now debating, talking about, and ultimately having our membership take a position on. And our membership has made it clear on the Grassley-Fisher bill is that we don't want more government in the marketplace. We don't want Senator Grassley and Senator Fisher coming in and dictating how we can market cattle. And also, when you look at that bill, it's a one size fits all in many shape, forms, and fashions. And we just don't have that in this industry. Your needs in places like Kentucky and Tennessee and the other states served by Mid-America Farm Credit are different from those in Colorado and Nevada, Washington, Texas. And we need to understand that those regional differences are one important and also do not allow for any sort of one size fits all approach. And just it goes towards where we have been for many, many years. It's just we need to do everything we can to keep the government out of our business because Congress, Senator Grassley, Senator Fisher, they can craft the most perfect piece of legislation that they possibly can. But we have to keep in mind that there's a lot of other people that get their hands on it before it ultimately is implemented. And it has been my experience that good pieces of legislation don't always end up being good regulations because of the different changes in the people who are implementing it. So that's why NCBA has pushed back on that. There's also been an effort to get a special investigator at USDA to enforce or do more enforcement of the Packers and Stockyards Act. One thing that we agree with both the special investigator and even with Senator Grassley and Senator Fisher is we need to make sure the Packers and Stockyards Act is being fully enforced. But we don't need another level of government, another level of bureaucracy to do that because USDA, the Packers and Stockyards Administration, already has all of the jurisdiction that they need to investigate and to prosecute. We don't need somebody new to do that. We just need to make sure that the Packers and Stockyards Division at USDA is being fully staffed and fully funded. And right now, there's about a 42% vacancy rate at Packers and Stockyards. So we need to fill those positions. If we fill those positions, then they will have the staff they need to go out to do the investigations, to find out where there are violations and to prosecute and ultimately make sure we do everything we can to enforce and apply the rules and regulations of the Packers and Stockyards Act. So while we agree with the need to get that full enforcement, a special investigator and yet another level of bureaucracy and more tax dollars going to that just doesn't make a lot of sense when USDA already has what they have. So we're pushing for full staffing and full funding of the Packers and Stockyards division over at USDA. But we're still engaged in this issue of markets and risk management. And as we go into what we hope will be the 2023 Farm Bill, that's our number one ask of both the House and Senate, is make sure that we have the risk management tools to help all of you as cattle producers manage these risks and be profitable. You hear a lot of talk in the world today about sustainability. As we look at sustainability, sustainability starts with all of you. Because if we can't keep you on the land, if we can't keep you on your operations, if we can't keep you producing cattle, then the rest of the discussion makes no difference whatsoever. We've got to keep you there, and that means risk management. There's some great programs like LRP, Livestock Risk Protection, the Pasture Range and Forage Program, all of these through the Risk Management Agency at USDA that we think can be improved, made more affordable, so that way all of you can use that and help manage that risk. And that's what we are focused on going into this Farm Bill. Another component of the Farm Bill for us is also making sure that there is a commitment to continue to fund the vaccine bank for foot and mouth disease. This is something that we were able to get authorized in the last Farm Bill, and we need to make sure that we keep it authorized because we are seeing issues in Egypt and Indonesia right now, and we need to make sure that we're prepared. And so that will be another part of our Farm Bill ask. You know, when you look at everything that NCBA is working on, a lot of this is discussed during our Cattleman to Cattleman TV series. If you are not aware of Cattleman to Cattleman, it's on RFD TV, and it is a network that hopefully many of you have access to. Every Tuesday night at 8 p.m. Eastern, Cattleman to Cattleman comes on, and we talk about all things going on within the industry and a lot of our policy issues and a lot of the cattle market issues, and also explaining more about LRP and PRF. Those risk management programs have been a part of shows in the past. So I encourage you to be a consumer of that TV show every week because there's a lot of great stuff in there. And I also just want to reiterate how important the relationship is between NCBA and Farm Credit. From the Farm Credit Administration to the Farm Credit Council to all the farm credit institutions like Mid-America, we have a great partnership and one that we really depend upon because of the services they provide to ensure that you have the resources needed once again to maintain, continue, and grow your operations. And we have a lot of the same issues that come up over the year. So definitely appreciate the opportunity to be here with you tonight. We could talk probably for another hour on a whole host of other issues, but we will have a chance a little bit later on to take a few questions. But in the meantime, I want to remind all of you, November 8th is Election Day. And so if you are going to vote early or vote absentee, make sure you look at your local jurisdictions and get all that paperwork filed. Or if you're going to show up to the polling place on Election Day, make sure you do that. We need you there because control of both the House and Senate is in play, and whoever controls Congress, or even if it's split control, is going to have a huge impact on just how effective President Biden will be in the next 2 years of his administration. And again, also going into a farm bill, it will be very important to make sure that we have friends on both sides of the aisle who are willing to step up and help us. And that's a key component. Any organization that tries to work in Washington, D.C. with only Democrats or only Republicans, you're going to lose. You have to have friends on both sides. And I'm happy to report that we do have friends on both sides. And we need to make sure that they are in positions of power and leadership to help us be successful in what we need to do to keep all of you on the land. So again, thanks for the opportunity to be with you tonight, and look forward to taking some questions a little bit later. Micah, back to you.
Awesome. Thank you so much, Colin. And we will save all those questions till the end. There's a whole slew of them that have came in. And so with that, Patrick, I think it's your turn.
All right, sounds good. Well, thanks, Micah, and thank you all for the opportunity to speak with you all here this evening. Um, so I'm going to run through quite a few parts of the market, just trying to give you a full outlook, an outline of some of the things that are going on, and really touch on mostly the macro trends impacting the cattle and beef markets here today. But before I get started, just a quick background on myself. So I'm the Director of Cattle Market Research and Analysis here at CattleFax. So pulling together all the data and information that we look at to try to get some kind of an idea on exactly where the markets are headed. And then I think the most interesting part of my job is then trying to boil all that down to what it means to folks like you, producers out there throughout the country, and help you navigate all the uncertainty that's out there, because there's certainly no shortage of that out in these markets today. I've been here at CattleFax for about 5 years. I'm a native of Oregon originally. I grew up with a cow-calf and commercial cow-calf and seed stock background out there, and my family still ranches out there today. So to go ahead and dive on into this discussion, and please continue to throw in questions as they come up, and we'll save some time for those at the end. As we start looking at what's going on in the economy, just start off with just taking a quick look at crude oil, because I think that really does explain a lot of the where we've been and where we're going in terms of the broader economy. We know that inflationary pressures were abounding across the economy long before the Russian invasion of Ukraine, and they've become clearly more profound since then. But as you look in the last couple months, we've also started to see these demand concerns cropping up across the economy. How is this inflationary environment and these inflationary pressures going to hit the consumer? And what does that ultimately mean in terms of demand? And are we in a recession, or are we heading into one? Well, I think this chart, again, looking at crude oil, clearly shows the elevated levels that we've moved to, up to north of $120 a barrel twice this year. But then in the recent months, we have moved lower, again, as the markets become more and more concerned, and even the daily news headline rotations, more and more concerned about recessionary challenges. And you can see the move lower that we've seen here today. And this is a pattern pretty broadly reflected, not only across stocks and equity markets, but across the commodity space. So as you look at corn, this is looking at annual average corn prices going back since the year 2000. And as we look at where we've been the last couple of years, this year and last year in particular, we've clearly moved into a higher range than what we've been used to for over half a decade. We've been more or less lulled to sleep in an era of cheap feed grain prices, predominantly between call it a 325 and 425 corn market. Now, clearly, we've moved past that range here today. And as we look forward, we're likely not going back to that prior range. It would ultimately take several crop years of large crops to relax the supply side of the equation. And then we also know that, again, thinking about the previous discussion on energy, another factor, that the global need for energy and the energy shortages that we've seen here, propping up feed grain prices as well. And so as we look forward, you have two things to note. For one, our forecast is slightly lower for 2023, but by no means anywhere near what we'd been used to prior to 2021. And also notice the wide price range that we have in there. And I think that's the most important one to note, that as we continue to see volatility in the marketplace, and also just moving to a higher price level tends to mean wider ranges with it. But our current forecast is that we likely don't take out this year's highs next year. and lower lows just by fractionally. You know, again, we can look at similar trends, across whether you want to look at wheat, soybeans, again, across the feed grain space. But as we think about the cattle segments, hay, another major expense, and obviously one that has moved higher here as well, as you're not only seeing feed grain or pressures from feed grains, but also these drought conditions across so many parts of the country, limiting hay production and ultimately drawing on those hay supplies so much harder than what we've been used to for the past several years. And our current forecast would be that we do see hay prices soften in the months ahead and as we look on towards 2023. But again, that common theme of still generally elevated, or especially elevated compared to the last couple of years. So front and center to many folks' mind and their day-to-day operations is obviously the drought. And we've dealt with it through basically every part of cattle country over the course of the last year and a half or so. Last year, the bulk of the drought, again, centered on the northern plains regions of the country. And through the course of last winter and in particular into this year, that's shifted into the southern plains areas. While parts of the West have received relief, but again, you can still see plenty of color on the drought map as you look on out towards California. But what's significant about that the southern plains area is just the sheer percentage of the nation's beef cow herd that resides there. As it sits during the month of August, the last month that we have a full month of data from, it was roughly 50% of the nation's beef cows that lived in a state designated as drought. And of those, 30% in D1 or D3 or D4 drought, exceptional or extreme drought conditions. So as we look going forward, this La Nina pattern that we're seeing, most forecasts calling for that to slowly subside. But as you look at these probabilities here from NOAA, you can see that as you do break down into the winter season, continues to suggest lower probabilities of La Nina persisting. But ultimately, that El Nino pattern that would bring more moisture to a lot of those areas, still low probability, but nonetheless transitioning into that more neutral pattern as you look on into 2023. And what that means in terms of the beef cow herd is, compared to where we are today, we don't necessarily need an El Nino, although I think that would be very welcome for a lot of folks. We don't necessarily need it to end the liquidation, but this more neutral pattern is certainly something that we need to see occur to stop the liquidation across so many parts of that country. So as it stands today, several charts here in front of you, but all coming back to the idea of beef cow culling and beef cow slaughter. As many of you have heard, beef cow slaughter year to date up 13% compared to a year ago so far this year, or to the tune of over 300,000 head more than last year. And mind you, last year was also a substantial number in terms of cow slaughter. And this is going to continue to have pretty broad implications. And our current forecast is that we'll still finish the year with beef cow slaughter up over 400,000 head compared to a year ago, likely narrowing the gap compared to last year here through the fourth quarter as we ultimately start butting into some packing capacity limitations in terms of the cow and bull slaughter capacities. But nonetheless, still finishing the year with a double-digit increase. And from a culling rate perspective, I think is where it gets really significant. What this would imply is a record large culling rate compared to how many cows we came into the year with, would equate to a record high culling rate of around 13.5%. And as you see on the chart below, would be, from a sheer numbers standpoint, the second largest going clear back to 1990. Obviously, a significant number of cows that have made their way to town throughout the course of this year. And we do have a forecast of that moderating as we work on into next year, but could likely see fairly elevated numbers still through the first quarter as you think about culling decisions made this fall, with those cows held over into the new year. So this obviously has implications to the beef cow herd. As you look going forward, our current forecast is a roughly 2% decline in the nation's beef cow herd into January 1 of next year. And as you look farther on down the road, it likely bakes in the cake that we see at least one, likely 2 more years of declines to the beef cow herd. Because also as you think about how many calves, heifer calves this fall, haven't been retained due to either lack of feed or lack of place to put them. So ultimately, you think about the long tail in terms of that retention decision this fall, really impacting the beef cow herd for quite a few years from now. And as the comment on this chart points out, as you think about looking back over our shoulder to the last drought cycle, taking a lot of similarities in terms of the shape and the trajectory of that decline. Drought was what forced us to a beef cow herd of nearly 29 million head there in 2014, and plus or minus those levels is likely where we're headed over the course of the next couple years. So with that, the slaughter numbers, as you think about the simple biological lag of the beef calf crop this year, becoming fed slaughter roughly 1 to 2 years from now. These trends in the beef cow herd pretty well sets in stone that the slaughter numbers, fed cattle slaughter, should continue to move lower into roughly the middle part of the decade. Our current forecast is for next year, fed slaughter to be down around 800,000 head, with another 800,000 head decline next year, and then likely another significant decline as you look further on down the road. So as we switch gears a little bit, looking at the beef trade side of things, looking at imports and exports, last year was obviously a tremendous year in terms of exports, as you draw your attention to the blue line here, pushing to a record high level, not only in terms of tonnage, but also in terms of value of those beef exports. And we're currently on pace to export an additional 5% on top of that significant increase last year here in 2022. Continue to see strong demand for our product globally, especially as you think about the growing global middle and upper class, especially in Southeast Asia. South Korea and Japan continue to remain strong trading partners. And obviously the explosive growth recently has been China. But also the other thing to note would also be the growth in the other categories. We continue to diversify our export partner basket, which is extremely important, as you think about diversifying your risk in case of, geopolitical factors, and the non-market effects that can, cause disruptions to trade. Certainly thinking about that diversity in terms of exports is a huge safeguard and insurance policy, thinking about already having a foothold in terms of those markets. Now, likely on the import side of things, our forecast is that, currently we're seeing a roughly 10% increase in imports this year. The bulk of that already behind us, narrowing that gap here in the more recent months. But nonetheless, as we look over the next couple of years, especially as you pull down on that beef cow slaughter rate, likely see a few more imports coming in, replacing that that decline in non-fed slaughter as well. So as we look across the total protein basket in terms of protein production here domestically, I think this is another useful illustration, looking at pork and poultry in addition to beef. The U.S. continuing to become a more and more significant player in the global protein production marketplace, and so much of that also on the pork and poultry side of things. Now, as we do look back over the past 20 years, we've seen where U.S. meat animal protein production has gone through trends of increasing and then flattening out, and then increasing again and flattening out. And we do anticipate that we're likely in another one of those flattening periods here going forward. Pork and poultry in particular can manage their production supply chain so much more closely to cost structures. And the parallel here, as you look back towards the prior decade, another period of high feed grain prices, and also economic challenges early in the decade, translating into flatter protein production. And again, these higher feed grain prices today likely translate into more modest pork and poultry production here in the near term. And at the same time, as you look towards 2023, that decline in beef accounting for the majority of that decline. And so from a macro perspective, simply producing less protein here, less competing protein, supportive to beef values, but a more flat protein production trend, supportive to values in general. So flipping the script a little bit in terms of the economy. As we look at the consumer and the state of the consumer today, it's clear that these inflationary challenges are weighing on consumer sentiment. It's continued to move lower, and not surprising, as you look at disposable income on the illustration in front of you on a real dollars basis, in other words, adjusted for inflation, you can see that since the COVID spikes with the large amount of government transfer payments that were thrown to the consumer, real incomes have continued to be eroded. Wages do move higher, but ultimately not to the pace of inflation. So while from an absolute level, the consumer is still at a relatively healthy level in terms of incomes, back towards 2019 levels, but obviously the recent trend that we've been on is not one that makes the consumer feel outstandingly great, and for good reason, because again, from a real dollars perspective, from a buying power perspective, they're not in as good of shape as they've been prior over the last couple of years. So what does that mean in terms of beef? Well, as you look at beef, prices here at the retail level in the upper left-hand chart, you can see we've had a pretty flat trend for retail beef prices really since the fourth quarter of last year. In that plus or minus 735 range, and actually, compared to the all-time record high in October of last year, actually moving slightly lower from those levels. And as you think about where we're sitting here today, in the next couple weeks, we'll get the September number, and recognizing that we're now have edged our way into October. We believe that the consumer today is likely seeing beef prices that are below year-ago levels. Now, still high from an absolute dollar standpoint, but lower than year ago. So from a customer retention standpoint, again, while the price is still high, they're no longer seeing higher and higher prices there in front of them, and actually lower on a year-over-year basis. At the same time, again, while beef was up 2.6% in August compared to a year ago, nothing near the percent increases as they're seeing across the rest of the protein landscape. And as you see, again, comparing those prices back to a base of January 2020, pre-pandemic, you can see again, beef made its move higher there early during 2021 and has been flatter since then, while the competition continues to move their prices higher. And so much of why we've been able to move the beef prices higher comes back to quality and meeting consumer demand. As you look at prime and choice grading percentage, it has come back here lately, but we were dumping a tremendous amount of quality product on the market. Again, partially a function of the backlog, but also those grade figures have largely stayed due to the improvements in genetics over time of the nation's cow herd. We were seeing where in 2021, nearly 1 in 4 cattle were grading upper 2/3 choice and 1 in 10 prime. So as the consumer picked up beef and spent their hard-earned dollars on our product, the probability that they had a wonderful eating experience was extremely high, and that resulted in a return customer and one that continues to reward us again with their hard-earned dollar, whether they're at the grocery store or out to eat. And again, that long-term trend of beef demand has continued to improve as we've continued to build a higher and higher quality product. Now, as we look at demand as it sits here today, it is lower on a year-over-year basis, but predominantly because of, again, inflation continues to move higher, but beef prices are not. But if you look at it from an absolute level standpoint, still on pace to see the second strongest demand here this year that we've seen on record. And again, we could still see some decline in demand depending on the depth of the challenges that we see as we look forward from an economic standpoint. But even so, this long-term trend clearly remains in play. And that improvement to quality should help us buffer to the downside on what we were looking at in terms of demand. And it's important to note that again, these beef demand trends have, as you compare back to the 1998 base, the low in beef demand have continued to translate to a larger pie in terms of the beef and cattle industries, and more dollars moving into the system. And then what that means to the cattle segments, so much comes down to a conversation of leverage. This chart looks at comparing 40-hour packing capacity, so Monday through Friday packing capacity, compared to fed slaughter, weekly average fed slaughter levels in the red. And so as we look over our shoulder, even pre-pandemic and the losses to packing capacity due to disruptions, inefficiencies, labor challenges, things like that we've continued to throw at the industry, we still had more cattle than we had processing capacity coming into this time frame. And so that obviously translated to many of the leverage and profitability challenges that existed even pre-pandemic, and that ultimately the pandemic and the related disruptions just made worse. But as we look going forward, what's important to note is that trend continuing to change. Again, we're pretty well set in stone that fed cattle supplies will be declining for several years. And then we obviously know of the number of packing capacity expansions that are well underway. Many of them, again, some of them may not come to fruition, but there's so many out there and so many additions to packing capacity that small ones that have already taken place that that trend will also continue to balance cattle supplies relative to processing capacity. Now, what that means in terms of price, again, these tighter net beef supplies, tighter beef production numbers, as well as strong underlying demand, has translated to a cutout, a wholesale beef market that's moved higher, and we'd expect to move steady to firmer in the next few years. At the same time, this leverage shift, packing capacity rebalancing, means that all classes of fed cattle move higher and gain a larger percentage of that beef dollar. Now, taking this back to the ranch, as we think about over the next few years, just a few thoughts here in terms of how do we manage around these cyclical price trends. One basic concept, one basic thing that we like to look at is just managing inventory. This compares clear back since the 1980s, a U.S. average bred cow price to a steer calf price. And you can see the tight correlation between the two. So as we do look towards the next few years, as calf prices move up, as I've laid out, female prices will move higher as well. And so if someone out there is looking to expand, expansion today is likely cheaper than expansion tomorrow. And then ultimately, it's several years down the road, but ultimately we'll see prices that move that find a cyclical high here at some point. And as you think about those bred cows that were purchased for maybe $2,500 during the last price cycle highs, and then sold calves in this lower price environment that we've been here today, many of those cows never paid themselves off. So as we do look towards the next several years, again, thinking about those implications and avoiding buying at the top. Now, here in the near term, looking at the calf market on a seasonal basis here this year, again, we've already seen the shift starting to take place in terms of higher prices. Calf prices up $26 per hundred on average, or 15% so far this year. Now, likely, as we work through the next few weeks, is the period where you do tend to see the fall lows. And there will likely be some more limited downside here in the near term, especially due to the lack of winter grazing in so many areas. But nonetheless, this strong underlying demand should mean that even at the lows, which we think are pretty limited here below us, substantially higher than where we've been for the past few years. And then in terms of the yearling market, this is looking at the feeder cattle index, so basis an 800-pound steer in the Central Plains. As you look on into the new year, and this is on a market year basis, so from July through June, from where we sit today, as we like to look at these non-expansion type of environments or liquidation environments, where you're heading into tighter cattle supplies, looking at a flatter price pattern there in the next several months, likely. Again, as you look at futures into early 2023, sitting there around the mid 170s, likely suggests some type of pattern like this is likely to play out here this year as well. Versus as you compare to a 20-year, a long-term pattern, you can see more downside as you work on into the fourth quarter. And that wouldn't be our current anticipation here today. A few other things for your radar here. I know we've had limited time here this evening, so I wanted to throw at you a few other Cattle Facts events or dates. We'll be having our 2023 Outlook and Strategies meeting here in Denver, but also with an online option the Tuesday after Thanksgiving. We do host a 3-time-a-year a webinar series targeted towards cow-calf producers. Our next one scheduled for January 11th. This online seminar, thanks to some sponsorship, is always free and open to anyone, including non-Cattle Facts members. And then we'll also be presenting our outlook at the NCBA convention there in New Orleans in February. And if that's still not enough for you, we'd suggest that, and we'd love to have you as a member of Cattle Facts to receive regular updates here as well. And one other note, I suppose, to some of Colin's points about LRP and managing risk and things like that, as we do continue to move into this higher price environment. Again, doesn't mean that it's a no risk environment either. So we do continue to suggest folks looking to manage risk and figuring out what works for them in their operations. For folks that don't like to use futures and options, or it doesn't work integrating that into their program, LRP has a lot of great options out there, and the increased subsidies over the past couple of years have made them pencil out for a lot more folks that it may not have made sense before. So again, the price trend, the cattle prices should continue to move higher and outpace any cost increases or most cost increases over the next few years. But nonetheless, it's not a no risk environment, and I think there's plenty of opportunities and ways that folks can look to manage risk.
Awesome. Well, thank you, Patrick, for sharing all that. And as Patrick pops his contact information up on the screen, one of the things that we've always really appreciated about our partnership with CattleFax is their willingness to work right with the producer. And Patrick's always great about getting back with emails and answering your questions. And so thank you so much for that. And then I'd like to go through some of these questions. We acknowledge that it is come to the end of the time of our webinar, but are going to continue to go into a little bit of an overtime here to answer some of those questions that producers chatted in throughout the webinar, as well as through their registration process. And so, Patrick, if you don't mind pulling your screen down here, and then we'll turn it over to Colin as he kind of tackles these first three that he's got on his docket.
You bet. The first one I want to address is a great one. The question is, do you know of any tax breaks for drought forced liquidation? Yes, there are, and that's a part of the work that NCBA has done in the past several tax packages under the Internal Revenue Code, Section 1033. It is the title is Involuntary Conversion of Draft and Breeding Animals. And what it does is, if you have an involuntary sale based upon drought, a drought forced liquidation, then you can defer gains for 2 years. And it gives you the time to recover and hopefully be able to restock without having to worry about paying those gains. For those of you looking at more than just your breeding stock, if you are selling, having to sell off more than just your cows, then we also have Section 451G, which is a 1-year deferral based upon being forced to market more than you otherwise would based upon drought. So those two provisions do exist. We are not tax accountants, so we do not give tax advice. Definitely encourage you to go and talk to your CPAs to make sure that you can take advantage of it. But those are the two provisions, Section 1033 and Section 451G. An excellent question. The one that comes up all the time is this one. It says 86% of registered voters support the American Beef Labeling Act. Why doesn't the NCBA support it? Great question. I will argue a little bit, because I don't think 86% of registered voters have any idea what the American Beef Labeling Act is. I don't think they have any idea what any act in Congress is. Regardless, I think your sentiment is spot on. When asked, and we've seen this in a lot of polls over the years, when asked, would you prefer to buy U.S. beef? Most consumers are going to say yes, but there's more to the story than that. So several things that I want to talk about. One is country of origin labeling was the law of the land for 6.5 years, and where every package had that label. And we did not see an uptick in prices for us, nor did we see change in the consumer's behavior when that information was presented to them. In fact, in research that was done, most of the consumers that were questioned when they were standing at the meat case actually didn't know that it was on the package, and it was right there in front of them. They were looking at price more than anything, and they were looking at color in a lot of cases. So we have experience in this, and we've learned that that does not necessarily work. But that does not mean that NCBA is not engaged here, because Patrick was very clear on the value that international trade brings to us as cattle producers. As part of that 6.5-year lifespan of mandatory cool, there was a World Trade Organization lawsuit brought forward by Canada and Mexico saying that violated our trade practices. And the World Trade Organization ruled in favor of Canada and Mexico, ruled against our program, and gave those countries the opportunity to retaliate against us to the tune of $1 billion. And that still exists today. So if country of origin labeling were to come back as it is in the American Beef Labeling Act, Canada and Mexico on day one would retaliate. And that's a hit to us, because if that beef that otherwise would be going into Canada and Mexico is sitting here on the domestic market, then that depresses prices for us as cattle producers. That's not good. But there are two areas where I think you will appreciate where NCBA has engaged. One is we are working with Secretary Vilsack right now to make sure that product of the USA cannot be applied to products that were processed out of imported cattle. So that is something that is allowed today. If it comes in from Canada, for example, and is processed in a USDA inspected plant, it can carry a label that says product of the USA. We have a petition in to USDA and Secretary Vilsack to get that fixed, to prevent that from happening. And Secretary Vilsack has indicated that's something that he's going to work on. The second thing is, when you go back to my comments of polls that show that Americans, when asked, will say, yes, I want product of the USA, I will take it one step further, and I'll ask all of you on this call, if you had the choice, would you buy product of Kentucky or product of Florida? When given the choice, what would you purchase? And more than likely, given where you all are from, that product of Kentucky is probably going to end up in your hand first. And there is a Kentucky ground beef program that exists today, put in place by the Kentucky Cattlemen's Association, and it shows that labeling does have a role, but it's not always necessarily product of the product of the USA. It can be a state label. It can be a regional label. There are other labels out there. And one of the reasons why we don't support the American Beef Labeling Act is because, once again, it's one size fits all. And we think there are multiple opportunities to be able to differentiate our product and provide consumers with something that's a little bit more meaningful than a government dictated label. And that's also a key component here. So we do have some opportunities to do more in that realm, and we are working on that. The third thing that I wanted to address is a great question about, do we see investors purchasing range ag land as a positive or negative impact to family farms and ranches? All you have to do is look at land values around the country these days to understand that outside investors are driving up prices. And it is harder for small family farms and ranches to be able to get in and grab up land when you do have people coming from outside of the industry trying to get, whether it's a hunting lease or if they want to have a hobby farm. That is a concern. It's something that's on our radar screen. The discussion of foreign ownership in particular has been a big one. NCBA actually had this as part of our discussions on policy, and decided that we did not want to support any policy that would restrict ownership because of the slippery slope that establishes and the precedent that could backfire on us, because we know that there are all sorts of activists out there that don't want us owning land. And so if we go and we support legislation that restricts who can own land, it could very well be used against us in the future. So we've been very careful to make sure that we don't take that route, even though, yes, to answer the question, I do think it has an impact on all of us who are looking to try to expand our operations. So, Micah, those are the three quick questions that I thought were really good ones.
Yeah, thank you so much, Colin. I appreciate that. And I think those are very valuable. Patrick, I think you had quite a few come in as well. And so if you don't mind.
Sure, a couple here. The first one, what percentage of cattle in feed yards do packers own or have part ownership in? That number does remain pretty small. As of last week's slaughter number, it was around 2%. And then another roughly 2% that may have at least some degree of crossover involve packer financing to some degree. So it is relatively small. Simply, I think my explanation would be just the large capital requirements, and the packing industry is pretty capital intensive of its own. Does tend to limit that just from an economic standpoint. Trends or emerging themes that potentially impact the industry in the future. I think the one that I'd really emphasize here is really the discussion on quality and demand, and really, again, meeting the answering the call of the consumer in terms of what they're really telling us with their dollars that they want. I think Colin mentioned the Kentucky beef programs that are established there. Local is obviously a hot commodity for consumers, especially quality local products. Things like that, I think, present a lot of opportunity. There's also, those, plenty of programs out there, premiums. If you watch these video sales, the cabs that are program eligible, whether that's for natural programs, NHTC, there's a number of, several dozen different programs out there that, some may not fit everyone's production style or fit into their operation, but likely there's something out there that potentially does, or with minimal changes may work for you. So just paying attention to that, and in general, the market does continue to pay more and more dollars for quality products. So those investments in genetics that you're all making do tend to pay off over time. And then the last one here I'd like to touch on, future of LRP insurance, and is it useful to the average cattle producer? As far as the future goes, it appears that that it will likely remain pretty well supported in the future from a policy standpoint, and I'll would let Colin correct me if I'm wrong, but it does seem that that's a major pillar of a way through policy that seems to have greater acceptance towards supporting the producer, helping folks manage risk. And I think for good reason, because it doesn't lock you into a future price, but does let you provide a floor to the market, which I think is extremely helpful, in this world of where black swan events seem a little bit more common like crows, to provide a way to lock in prices. And especially, again, as I laid out, the price trend should be higher for the next few years, but that doesn't mean that insurance products or looking to manage risk, taking advantage of premiums, still have a place. But what's awesome about those is that they do work for producers of any size, compared to a futures contract that's based on load lots of cattle.
Now, I would just tack on to that. I think that's what's key, is a lot of times I believe that especially cow-calf producers think that risk management is only for feeders, big feeders in particular. And programs like LRP truly do make it available for cow-calf producers to be able to take advantage of some of these risk management opportunities. And that's why we are focusing on that for this next Farm Bill.
And Patrick, Colin, guess where you can go to learn more about LRP? We have a team of individuals here at Farm Credit Mid-America that would like to support you through navigating what that could look like on your operation. And so as you think about what your risk management plan looks like heading into the 2023 year, we hope that you'll reach out to your local crop insurance specialist and Farm Credit Mid-America retail office so we can help to build out what that risk profile is for your operation and look for ways to be able to help secure some of that risk. And so with that, thank you both of you, Colin and Patrick, for joining us this evening. Thank you to all the attendees that decided to take some time out of their evening to join us and hopefully gain some of this valuable information that Colin and Patrick shared. In addition to reaching out to Farm Credit to talk about what your risk profile could look like for the upcoming year, I do also want to highlight an event that we're hosting at the end of November. And so Patrick's team is really great about providing market outlooks and talking about what some strategies are that producers can use. And so we want to be able to take that information and help customers understand how to use that information to make change in their operation. And so November 30th and December 1st, Farm Credit Mid-America is hosting an event called Financial and Risk Management Seminar, specifically focused on the cattle markets. And so if you are somebody that maybe is a little bit overwhelmed by the markets and not sure how it can specifically apply to your risk management strategy, I would ask that you reach out to your local financial officer to get you more information. With that, this recording will be sent out to all registered guests within the next week or so, as well as posted on e-farmcredit.com. And so thank you all so much for joining. Patrick, Colin, it was a pleasure. I hope that you enjoyed your time this evening as well. And thank you all for joining, and have a safe night.